today and see if there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular. Hey everyone, welcome to the live stream. It is a special stream for my channel. I'm bringing back Scott with Scott's Due Diligence to talk about the market, talk about stocks, see what's going on, and just check in with Scott. He's a big YouTuber that provides many videos, so it's great to have him back. How you doing, Scott?
Good. Thanks for having me. It's always good to do a live stream. Even though I'm sure the people watching are watching to hope to learn something, but I actually learn a lot too, because there's sometimes I don't think of something. There's something about the market or something I learned a while ago that I haven't thought about, and somebody brings up, and I have to relearn it. So I definitely enjoy these, just talking with the audience. So anybody ask questions? I think I'm streaming on my channel. If anybody could comment and confirm that. So yeah, just throw out any questions, and we'll just have a good time.
Yeah, I agree.
How you been, Victor? How's everything going with you?
Things are excellent. The market's been really good. I've made a substantial amount in September. I'm in the green in October, but knock on wood, that could change very quickly if the gods of the stock market decide we shall go down. But I mean, it's for year to date 2024, it's already a really good year. It's going to be another good year. So awesome. 2023 was an excellent year. And I'm looking forward to, I don't jump too far into the future, but I'm always trying to think what's going to be a good investment for 2025, even 2026 to a lighter extent. But I'm really looking forward to seeing how a couple of trades are going to evolve, like the China trade. Is it going to keep going? Is the technology trade, especially the AI trade, going to keep going? Is it still going to keep going up and up? I think we're going to have earnings, and it's going to be really interesting to kind of get into those earnings and understand what's going on. This past, I guess Friday, we had a lot of banks announce, and what was interesting was their revenues didn't go up a whole lot, but I guess the market thought the earnings were going to be bad, and they came in with okay earnings, fair earnings, because revenue was down. So I'm like, revenue's down, but JP Morgan went up 5%. Revenue's down, but Wells Fargo went up like 5-6%. Even
banks
the
are
other
doing
banks
really
went
well.
up. So I wanted to, one question I do have that maybe we can get into a little later, just give you time to think about it, is how do you evaluate banks? I know I don't use free cash flow because it could.
No, you can't use free cash flow.
Yeah. So I'd love to get your opinion on that. I'll tell you how I do it. I'm not saying my way is the way. I'm just saying these are two factors that I believe give me a sense that bank is discounted and worth buying. But that'd be a question out there to you, is how do you evaluate banks? Because that's different than regular companies.
Yeah, this is a fun topic because it's not straightforward. I guess nothing about valuation is straightforward, but if you've done valuation for a little bit, at least valuing like a regular like manufacturing company is pretty easy if you've done a valuation, I'm saying. But valuing banks, like, it took me literally 2 years after doing my channel to really grasp how to value a bank, and I'm still learning from it. But so generally, when the Fed cuts interest rates, it's good for banks, and they did cut it 50 basis points in September. And there's a meeting November 6th for another potential Fed cut or a Fed raise. They meet 8 times a year, and they haven't been raising or cutting rates for a while until that 50 basis points in September. And so the past 2 years, the banks have been dealing with the inverted yield curve, which is kind of detrimental for companies like for an industry like a bank. So just to educate you a little, so inverted yield curve is when short-term interest rates are higher than long-term interest rates, which is kind of like the opposite. It's kind of like you go to the store and say, I want to buy this candy bar. How much is it? And they say 50 cents. And they go, okay, how much is 2 candy bars? Do I get a discount? And they go, no, it's $1.25. Why would you buy 2? Just buy 1, then buy 1 again, right? So when you buy a lot, you get a discount. So short-term rates were higher than long-term rates for almost 2 years. And banks borrow at short-term rates, so they had to pay a higher rate, lending at a lower rate. But now that's coming back. And that's why, like Victor, you mentioned, bank stocks are doing really well. They did great this past week. I'm trying to think. One bank went up like 50% the past week or so. Can't remember which one, but okay, that's kind of more of a higher level economical. But you have valuation, so
yeah. Let me tell you how I go about it, and I'd love to get your feedback. I've been watching your channel for 4 years, so if you have constructive feedback, I'm completely open to it because I have that level of respect for you. So I look at 2 things, and like many others, I've learned from YouTubers, and there's Cameron Stewart. I don't know if you've ever seen his channel.
Oh yeah, I like him a lot. He's really good.
He's a CFO. He gets like totally into like financials, and he evaluates banks in a way that makes sense to me. And he evaluates based on 2 criteria: earnings makes sense. If they're profitable, making money, that's very good. And book value. He wants to see appreciating book value. And when you look at like JP Morgan, their book value is exceptional. I owned JP Morgan for like 5 years. And you look at this book value per share line, you're going from 76, 81, 88, 90. It's a very nice, smooth upward chart. So that's very good book value. And it represents the greater the book value, the more valuable that bank. Now, if the share price is getting out of control, like the share price tripled, that book value per share is going to go down because the share price is accelerating too fast. So book value is one of the metrics that I use, and I want to value it based on my expected growth rate in book value are projected into the future, and similar to free cash flow projections, but we don't use free cash flow here. And then I value the company as if I'm buying it, holding it for 10 years, and then I do an internal rate of return calculation to get back to today's net present value. And that's one metric that I look at. And then earnings per share is pretty simple compared to that. And I use that, and then I combine the 2 and take the average.
Yeah. Using the income statement makes sense for a bank. Free cash flow is a bit wonky because like if you were investing in like a semiconductor company, when they take on debt, they use that debt to kind of fund things like to buy factories or to acquire another company. But banks take on debt to lend back to their to provide loans, because the ideal situation is a bank would receive deposits from people looking to put money into a savings or checking account or maybe money market account, and they would take that money, pay a 1%, 2%, 3% to the person lent to them, and they would lend that. They would take those funds and lend it out to someone who wants to buy a home or buy a car, and they would lend it for like 7%, 8%, 9%, and that spread, the interest rate spread, is how they make money. That's the main way banks make money, on the spread. It's
a 100-year-old model. And I agree that, like, here's JP Morgan. And if you look at their statement of cash flows, it doesn't give us, like, good data is sequential growth, right? Like it just showed you their book value. It grew nice upward and somewhat smoothly. But when you have operating cash flow going from minus 79 billion to positive 78 billion to 108 billion to 12 or 13 billion. It's
You
very
can't look
hard to
at
say what's going to be the next year. Plus, a lot of these items are based on their business model, which is we lend out money and we
right. You
borrow
can't look
money.
at
So our ARAP is having these drastic moves because it's almost like the factory for a bank, to use that analogy, is in the P&L. They're lending money, they're borrowing money. That's their production line, as opposed to, let's say, Ford Motor. They bring in parts together, they assemble them, they ship them out, and then they recognize revenue when it's sold. So that's the big difference. Is free cash flow doesn't fit a bank. We got to
right.
go through a different technique.
I mean, if you the only way you could use it is you have to. It's very complicated. You'd have to really dissect the balance sheet and pick apart a lot of things, and it's almost impossible. So yeah, you would want to avoid it because a lot of the say a bank starts today. So our first year in business, we're going to lend out a lot more money than we're going to receive from that lending. Because say I'm a community bank, and the main way I loan money out is when people want to buy a home in my community. So they come to the bank and they borrow money, and I give them $100,000, $200,000, and that's over 10, 20, 30 years. So I'm going to be lending out a ton of money in year one, right? And hardly anything's coming back to me. It's going to take the average mortgage loan is paid down in 7 years, usually from a refi, not from them paying. But so that first year, you're going to see this huge negative in cash flow, and you're going to say this bank is awful. They're losing so much money, but they're not losing money. They're lending money out, and it's not like they didn't get anything for it. It's like they got a home for it. The bank owns that home until the person pays them. So they're going to have to wait a decade to get that money back or take the property. So that's why you can't look at cash flow, because 1 year it'd be huge negative and another year it'd be huge positive. So that's why you got to look at book value, because it takes into account the debt versus the assets, which is the loans they lend out.
And once I get to some calculations on a bank, it's always good. You do this very well on your YouTube videos, is you compare the company to its peers. Like you did today, you did Alibaba versus Amazon. Excellent. Thank you for doing that. And thank you for the last 4 years of me watching your videos, because it's a very good comparison of peers. Now, what I did with these banks, and I did this before the live stream on Friday, this is a simple one. I'm sure we could add Bank of America. We could add a couple more banks in here, but these are 3 big ones, right? JP Morgan, Wells Fargo, Citi, these 2 announced. And then you could break it down and say, okay, well, JP Morgan has this share price and they have this book value. Okay. Now, if I compare the book value to the share price, it's at basically 47%. And Wells Fargo is a little better, 75%. But Citi is at a very different level, 150%. So this is more attractive to me. And then if we look at earnings per share, I ran the discounts based on earnings per share. JP Morgan's fairly priced. I own JP Morgan. I did well with it. I decided to, switch horses because this horse looked really good. And this is why, is the metrics showed me that, hey, this is probably a discounted bank. So far, so good. For the last 12 months, Citigroup has outperformed JP Morgan, and I think it has a little more room to run. So I look at earnings per share discount, and that's something that I do on just about every company. I think I do it on every company just to know what it is. And then I look at book value and I compare book value versus the share price. And I'm trying to get a very high number while having a very reputable stock, right? Like Citigroup's solid, too big to fail, too big to fail, too big to fail. The government's going to prop these up, because if they went down, they would take down 100 different companies. So that's what I go through on banks. And it sounds like we're somewhat in the same neighborhood of thought.
Did you? So the price to book, this is the price to book. It's the market cap over the book value.
No, book value per share.
Well, yeah, stock price over book
So
value per share.
that'd be the book value divided by number of shares, right?
Well, yeah, this is price to book. You could do the market cap over book value, or you could take stock price over book value per share.
Yeah, agreed. Yeah.
So so you're doing it 70 over 50. So you're doing book value over stock price. You're inverting the price to book.
Yes.
So yeah, so in this case, you would be looking for the higher percentage. Is
Correct.
Better. So if you were looking at the price to book, which is a common metric, it's the opposite of what you have. So that would be the lower the better.
You'd want the lower, yeah.
But in this case, it's the higher the better. So, so that's one part of it. This is the main part to value a bank. But then you have to kind of, this is the really difficult part. But so Citibank appears the most attractive. So does that mean it's a better investment? Maybe. It's not cut and dry. Then you have to look at their loans. Like, are they lending money to a lot of risky borrowers? And if that's the case, you have to weigh that. How it seems like their credit terms are a little looser, because generally when you have a really attractive ratio, you have to do lots of business. So you can't have tight credit terms and just only lend money to the people with the highest credit score. Like JP Morgan may say, you have to have a credit score above 700. And Citi's like, well, we'll take 650. So that's why they have a larger number of people they can loan to, which gives them
and I think these are not perfectly comparable. I think JP Morgan has a particular type of business. Like they do a lot of they have a retail bank, but that's not the principal business they have. They have Chase, brokerage in Morgan. They have they're more of a private equity bank. The business banking's big for them. They're kind of like a big deal maker, on Wall Street. Wells Fargo is in big part a retail bank. That's what we think of a bank. They also do a lot of mortgage. Citigroup is probably more similar to Wells Fargo, but a little different. So they're all kind of like a little different. When I look at banks as well, I try to understand, well, which one's going to do better going forward? Like JP Morgan, when we were dealing, like coming out of the subprime, market meltdown, the Great Recession, their deal making made them a lot of money because there was companies that needed liquidity and they needed big loans from JP Morgan, and they were making money hand over fist, which was great. But then once we got out of that phase, kind of high level qualitatively, I thought, well, those days are kind of behind us. We don't have a big monumental catastrophe that's going to take down our economy. So should I switch? That was part of my reasoning. Should I switch horses maybe to another bank that's going to do better for the next 5 years? So far, so good. I was able to leave one stock and get to another, still have exposure to financials. Financials were really attractive in 2023 after the Silicon Valley Bank meltdown that I think investors just were in fear. They didn't understand. It was a paper write down. It was not like they were scratching checks for that money. They just had to write down their long-term bonds because they lost value because of the fast rise in interest rates. But nonetheless, they still had a run on their bank. They went down and it brought the whole sector down like 20%. It was a great opportunity.
Yeah. That was unprecedented because usually.
And here it is right here. Here's what I'm talking about.
Exactly.
Right, no, that's not it. I'm pointing to the wrong thing.
Okay.
It happened in 23. Happened here it is. So it happened in the springtime and the whole kind of sector got pushed down. Some more than others, like Wells Fargo got pushed down more. And it was an opportunity back then.
Yeah. And usually the FDIC, when you put money into a bank like Chase, the FDIC will insure you up to $250,000. And at Silicon Valley Bank, it had most of its deposits were uninsured because most of the money at the bank was above the $250,000 threshold. If you go to a community bank, like a bank that serves a smaller community, probably like almost the entire, probably almost every dollar put into that bank is insured because very few people have $250,000 in a savings account. Most people have like 10,000, 8,000, 20,000, maybe the highest is like 50,000. So it's all insured, right? But if you have a lot of people with like millions and millions and tens of millions, then it's a lot of uninsured deposits, right? That was the big issue because ever since the Great Depression, banks could fail and people wouldn't we wouldn't go into a Great Depression because of FDR. He came up with this insurance for the banks. But it was unprecedented because what the FDIC did was they insured everything from Silicon Valley. So they say, okay, we're going to insure every dollar, which really ate into that insurance fund, the bucket, and it's going to cost the banks more money, which will probably fall into mean higher rates for us. Because as you guys know, the FDIC insurance is funded by the banks themselves. It's not funded by us. The banks have to pay a certain percentage to the FDIC for that insurance. Even if the bank never has financial problems, they still have to pay that insurance. But I think it's funded pretty well, even though they gave so much money to Silicon Valley.
Yeah, good stuff. So I think we covered banks. Thanks for your thoughts on that. And It looks like we've got some comments coming up. Let me try to read through them and see which ones are. Looks like Kiter.
I like Stinkbit has a couple of good ones that I want to talk about.
Yeah. So we'll get to those. So related to the topic we just left, I wanted to just hit those and then we can move on to Stinkbit. So Mr. Kiter, thanks for joining. So glad you said that cutting rates is good for banks. People got me saying the increased rate. I would say that, depending on the scenario, if rates go up, revenue goes up. So that's somewhat of a positive, but they're paying more for that debt. And as they come down, revenue comes down, but they're borrowing, especially when we became uninverted, when we went back to what should be normal. Short-term rates are lower than 10-year rates. The 2 years lower than the 10-year. For a while, we were like upside down. The 2 years higher than the 10.
Right.
So I think once we got back to normal, now banks are going to be okay. The other thing I look at is economy. If the economy is good, fewer companies and individuals are defaulting on loans. If fewer individuals are defaulting on loans, that means banks are not writing off debt. That's good. They're taking on more debt to buy stuff because they're like, oh, things are good. I'm going to buy a new car and I'm going to get a loan from, Wells Fargo. So that kind of thing is going to happen. So I look at economy as well. So that, I think, is the last comment on banks. Let's turn our attention over to Stinkbit. He's got a number of companies. Let's pick one to get started. So he's talking about, SoFi is irrelevant. So I'm long SoFi because SoFi is like a new generation bank, so to speak. And
I just did a video on them. I didn't edit it yet. But.
So every time I look at SoFi, I'm down on SoFi. And it's a little bit of because the alternatives are really good. Like instead of going into SoFi, I went into Robinhood. That turned out to be great. I went into Coinbase. That turned out awesome.
Yeah,
and now I see other options to SoFi. The things I don't like about SoFi, and I can put some of that on the screen, is
I have their quarterly presentation slides on my desktop.
You do. You want to share that?
Yeah, I could. I think it's
While you prep that, and once you stage it, I'll put it up there. I'll just kind of finish my thought, which is, so as I look at SoFi, right, I'm looking at their income statement. The revenue is growing nicely, but it's not incredible, right? They're still somewhat small, 2.3 billion in revenue. So they're growing nicely. Now, when we look at the quarterly, their last quarter, the growth decelerated to some extent. And I just think that they're unprofitable.
They are.
They have a long ways to go. They
Very
may
unprofitable.
start getting into cash crunches. So there's a lot of risk there. And I think the other alternative is that I see a line of sight, like Robinhood, I had a total line of sight on free cash flow. I think their business is very new and unique. They really stick it to new, legacy brokerages. Legacy brokerages follow Robinhood. It's like the little tail is wagging the big dog. When Robinhood changes things, they start selling crypto. Well, guess what all the other brokerages are doing now? Selling crypto. Everything that Robinhood's doing, it's kind of setting the trend in the industry. That's really interesting. And Robinhood's profitable. They generate, and that one I do cash flow because they're not a bank. They're a brokerage, financial services company. So that's the reason why SoFi never makes it into my buy list. Now let me stop sharing and let you share your screen.
Okay. Yeah. So I've done a bunch of videos on SoFi. It's an interesting stock because I'm invested in Nubank, which is a Brazilian fintech, which is like the SoFi of South America. So it's the same company. I'm up 250%, and I've only invested, I think 2 years now. June 2022. So 2.5 years I've been invested in it. And this stock, if I invested in this, I'd be up 10%. So it's just not moving. It's not moving. And you kind of question why. But like members, which I think is probably one of the more important numbers to look at, like with a company like Meta, it's number of users or, people use different terms. But you want to look at how many people are subscribed to that service, especially when you're losing money. Because if a company's losing money like they are, and like Meta did, and like Amazon did for decades, you have to look at something to see whether the company is improving or not. So you look at members, and they went from 1 million to nearly 9 million. So they're at 9 million right now, members. So members are people who use the bank for some reason. Either they have a checking account or took a loan, or maybe they trade. It's come down though. The rate has come down. They grew 41% when you compare to Q2 2023. It used to be triple digits, but when you have 6, 7, 8 million members, it's harder to grow at these triple digit rates.
The other thing that I dislike about SoFi is they're kind of going after a part of the industry that doesn't make a whole lot of money, and they're going after some giants, right? Like I think they're primarily a banking solution, if I correctly understand them. And if you look at, well, who's in that space, right? Wells Fargo, Citigroup, Bank of America, and you have all these regional players. And it's like, well, it's not the most profitable part of the industry. Profit is in like brokerages and true financial services, payment systems. And that's where like better margins are achieved. And that's a difference in SoFi compared to other companies that are financial services.
That is true. But this next slide is number of products. So of the 8.8 million members, they offer, those members have used 13 million products. So some members just have a loan with SoFi. Some members have a loan and a checking account. So some members have,
and they're trying to take like student debt, right? Like if somebody has student debt, SoFi will refinance it, and then they'll owe that money to SoFi.
Yeah, they do mortgages, student loans, home loans. That's pretty much, I think, how they started with loans. But they acquired Galileo, and Galileo is a credit card processor, a payment processor, and that, like you said, that has much higher margins than a traditional bank. And Galileo has 158 million users. Although the in terms of revenue, it's not a huge chunk of their revenue, but in terms of number of users and margin, it's a good business model.
Yeah.
So they acquired Galileo a few years ago, and that's grown pretty much every quarter, just about. Actually, you mentioned they're not as much into the financial services, but they project. Where's that slide? They project in 2024, half their revenue would come from lending, which is like a traditional bank, and half will be their technology platform and financial services. So they do crypto trading. They have an insurance arm where they provide insurance. So they are growing that part of the business, which I think is why their revenue is growing, and they're projecting in 2024 positive net income of 180 million.
Good. That's very good. The stock may start working. I hope it does. I hope it does for all shareholders. But I think, what I like to do is, you share your opinion. I listen to it and I'm like, it's interesting how you evaluate it. And then I form my own decision and I share my opinion. And really what I hope it serves is you guys just hear, I'm an investor. Okay. I invest my money. I invest in Robinhood. I could talk about some of the stocks that I lost money on, like Intel. I lost a fair amount of money on Intel this year. I'm doing fine, right? I'm doing great this year, but investing comes with risk. And I think one of the value adds of being in a community on YouTube is listening to other investors and seeing, okay, what are you trying to do? How are you trying to make money over the long haul on that stock? What is your true opinion of that stock? So I don't intend on being rude to anybody. Hopefully nobody takes a comment that way. It's actually really maybe constructive, because if I own a stock and somebody has a differing opinion, it helps me go look in areas maybe that I overlooked, and maybe something I didn't know. And then I recommit to the stock, or maybe maybe it changed my understanding of that company a little bit. So,
yeah, but
all right.
With SoFi, I'm not just saying they're going to be profitable in the future. They were profitable the past 3 quarters. You can see here, 17 million net income positive, 88 million positive. If you look at the trailing 12 months, it's negative because of this negative 266 million. But after this, starting in the 3rd quarter, it's going to be positive because all these negatives were in the past. So it looks like it's a good investment. I guess I'm not invested in it.
When did they announce? So they announce on October 29th. And based on what you just shared is, here's my prediction. That and $3 will buy you a cup of Starbucks. They're probably going to announce positive net income. And once you have a full year run rate of positive net income, I think it's going to change the metrics so much that this stock may really rally after their earnings.
Yeah. And a lot of things about the who becomes president, that's going to move things as well. Although
I'm going to write you in, Scott. If you get enough votes, you can run the show.
There you go. Yeah.
All right. So let's move on to the next one. We're going to leave banking and we're going to go into the very interesting area of technology. I'm going to let you pick among 3 stocks: CrowdStrike or Snowflake or Bill, which is kind of a software SaaS company that does like back office applications. Which one would you like to work on?
Well, what's just got on my mind right before this was CrowdStrike, because I remember when they had the
outage.
The server went down a few months ago, and the stock was down about 50%. And I thought to myself, this is such a great time to buy. And of course I didn't, because I guess every time, if I took the last 10 times I said, this is a great time to buy, twice it was like
Oof.
I was correct, and 8 times
You left
I was wrong.
47% on the table.
Exactly. Because I was really bullish before that that server crash, and with the server crash, you knew the company wasn't going under. Companies get sued. There's always problems, but you adapt. And yeah, I still think I'm still bullish. It's trading probably like 30% below its all-time high, and it's such an important stock because of all these data centers and all these tech companies. They need security. They need these companies like CrowdStrike.
Yeah, and I have I'm going to call it a strong opinion on CrowdStrike. I'm trying to say some. So first, just to qualify my opinion is, so I've sold enterprise software for 20 years. I've either consulted, helped companies select software, implement it. I've helped companies select infrastructure, roll out big systems, and a lot of that has security in it. So I know that CrowdStrike has a product that in the enterprise, it's very popular, but I would completely expect that Microsoft was fairly upset with CrowdStrike when that happened. A lot of their customers were non-operational. Delta Airlines is trying to sue both Microsoft and CrowdStrike. And Microsoft was kind of going along, was taken down because of CrowdStrike. So where I'm leading to is Microsoft and Google have the resources to basically create security software that's as good or better than CrowdStrike. And when you go to a customer and you say, hi, I'm here with Microsoft, and instead of running CrowdStrike, wouldn't you want to run my software, which is from the biggest software company on the planet? And we just didn't want another outage from CrowdStrike again. So that's why we're going direct. If you look at Apple's model, they control their entire tech stack, meaning they control security on their technology stack. Microsoft lets partners like CrowdStrike run security. But after that outage, I think the first time customers will go to Microsoft and say, hey, we were really upset with that outage. We know it's not your fault, but we don't want that to happen again. If it happens again, I think they're going to have a different kind of talk track with Microsoft. They'll be like, we got to get the heck out of, CrowdStrike. So I know that there's an expectation it's going to bounce back. If you played the stock, I think you're doing just fine, right? You're still down from the high, right? You're still down 18%, but that's not too bad considering they caused the biggest outage in the history of computing. Man, that's not a title you want. And the stock really collapsed. So yeah. CrowdStrike, I think, is at strategic risk now. It's not like, hey, they can go back to the way things were. No, things are not like they were before. You just caused the biggest outage in the history of computing. The big software companies do not want that to happen again. They're going to be looking to put more R&D to replace you because it's in their best interest to keep their customers operational.
Yeah. So it sounds like you're bearish, CrowdStrike, because you think this outage is going to cause like a trickle effect.
And absolutely,
and that makes sense to me. It definitely does.
PE of 461. Jeez.
Wow.
Now you're 461, right? And you're like, well, their growth must be amazing. 33%. That's not amazing. You know what amazing is 100%, 200%. NVIDIA is amazing. Meta is growing at 24%, and they're over $100 billion in revenue. Microsoft's growing at 24%. They're like gigantic. 33%? I'm not impressed.
Right.
For when you are carrying a PE of 461 and then at 87 next year, you got to show me amazing. You got to show me 100% because your top line revenue is not that big, 3.5 billion. It's not that big. Microsoft, I'll open that guy up. It's gigantic, and they're growing at a very, very strong clip.
just to be fair to CrowdStrike, they're a younger company, and they're kind of like Amazon was in terms of like this PE ratio thing 15 years ago, because they just became profitable. They've been running at a loss for a while they scaled their business. So they had like their first, I think, only the last 2 or 3 quarters of positive net income.
Yeah.
So it's gonna look really weird. You know, if we looked at the stock a year ago, we couldn't even look at the PE ratio because they had negative earnings. So it's kind of a tough ratio to look at because it's really weighted down.
And my bear sentiment toward the stock was when they reached this level. I was like, this is too expensive of a stock. Because if you look at other comparable software companies, you could just get so much more value out of those companies, and they're growing at the same clip. So this is just on the investor's mind that, hey, security software is really important. I get that. But if you follow who's on top of the stack for security software, you have an evolution over time. You had like McAfee used to be dominant, if you recall. They're really not a player anymore. And then you move on to Cisco as a player for a while. They're not a player anymore. So we'll see. We'll see how long they could go. I started being very bearish on CrowdStrike here. I shorted the stock. It was luck. They caused their biggest outage. It dropped. I held that short position for 10 days, and then I got out of it.
That's amazing.
That was lucky. It was lucky.
Yeah, it's a huge industry. So you don't, if you're bearish, that's a beautiful thing of the market. If there's a stock you don't like, then you can go with like Palo Alto Networks, or I like Akamai. I think they have a really specialized service. But if you want to go with an old timer, go with Cisco. But yeah, there's a lot of companies in this space, and there's going to be more because there's so much demand for security.
And you look at security, right? The other threat to it is AI. AI does a couple of things really well, and machine learning and kind of doing what security does is something it's going to do really well, because you can have AI bots just looking at your network 24/7 every moment of the day. This thing is looking for threats. It's identifying threats. And even in some cases, it could probably write a little bit of code, boom, put it in place. It's just, it's an area that's going to grow, but that's where we're at with CrowdStrike. So you got 2 opinions, I think, on that one. If you're all right, we'll move to what Neil Weston. He's got a symbol that I'm not familiar with. THKU. THKU. I don't have any match.
I don't think he meant that, because that's not.
Oh, thank you.
Okay, yeah.
Man, I'm too old for these like acronyms, man. These guys, how funny. All right, so let's move on to the next one. Shadow Guy, how you doing?
He's not American, Neil, so I think he's speaking in his own New Zealand language, which is kind of American, right? It's English, but I know you use words differently. So
Jerry Seinfeld, we have the great Jerry Seinfeld on our live stream, because he doesn't have enough money. He's got to find ways to make a little more money. He's looking at Geo.
Is that the gel company?
So this is Jerry Seinfeld, the Jerry Seinfeld, I think. And I guess he wants to look at Geo. And what is Geo?
It is a prison company. Okay. I'm surprised.
Yeah, this is the private prison company. So
people hate this company. They get so many negative comments. And
I think if you get a Republican in office, Geo's going to do well. If you get a Democrat, Geo's not going to do well. That's just a situation. I understand the private prison kind of economy, I guess, and that's where they're at.
Yeah, private prisons. I mean, it's another business, right? Because the government has only so much money, right? The government can't do everything. So we have companies that buy and sell electricity to compete with the quasi-government backed companies. Then we have companies that build prisons, and they get funding from the government because the government can only afford so many prisons, and most of those prisons are actually full or overcrowded. So you have a company like Geo trying to take advantage of that, and I don't see anything wrong with it, as long as they're doing things ethically. If they are treating the prisoners poorly, which of course you read about any company, you can read that about like Apple. People in China who are committing suicide because they work too, whatever. So, but are you guys familiar with what we're talking about? It's a private prison where it's a business, a for-profit business that starts a prison, and the government funds them, and they have to hold people in the prisons that are prosecuted by the courts, just like a prison that's owned by the state, and they have to just follow the same rules.
Yeah, I think they get the negative press because I guess there's some social arguments that, hey, you're imprisoning too many people, and we're not investors in the social topic. We're more investors in, hey, is Geo the kind of company that's going to work? It looks like they produce free cash flow, and they're not growing their free cash flow tremendously. They're growing it quite nicely. I think you could probably value the company at around their market cap, but from what I know, this industry is, if Republicans win, this thing's going to go up 10, 20%. And if Democrats win, maybe it gets a little bit of a haircut because the prisons aren't going to go away. But I think Republicans are more of outsourcers. Like, hey, government can't, like, Republicans will want to shrink the government and privatize certain services and things that the government does. So they would kind of get a tailwind of, hey, let me privatize a prison in whatever area of the United States, and then Geo would have a better growth for 4 years if Republicans entered the office of the White House.
I think they're considered a REIT, Geo,
really?
I believe, because they operate as a.
So according to Stock Analysis, they are security and protection services. It's an industrial.
Okay, so I'm wrong. Okay, I was thinking it was more like a REIT, but okay. But either way, the reason I don't like stocks like this, and it's the same reason it's not like I don't like the company. I just don't like the stock as an investor. It's the same reason I don't like to invest in cannabis stocks or gambling stocks. It's just that it doesn't get as many buyers as a tech company, even if they're the most wholesome company, like they do everything well. Geo, they treat prisoners well, they try to do the best they can do. People just have a negative perception of that, and what moves the market is not people like me and you. It's like those big funds like Vanguard, who have multiple trillions of dollars to invest. They move the markets because those big funds or hedge funds or private equity funds, they can buy like tens of millions, hundreds of millions of dollars of stock at a time. And most of those funds or ETFs, they don't invest in stocks like this or cannabis stocks just because of the negative kind of
totally
sentiment.
Get that. So did you see Jerry Seinfeld live?
Yeah, I did last week.
It must have been hilarious.
As a birthday present. It was I always wanted to see him, mainly from the TV show, but I've always liked him as a stand-up comedian. But it was fun to see him live.
So he hosted Eddie Murphy on his Cars and Coffee show.
Yeah, I remember that one episode.
Something I find it amazing to think about is he started his career at the same time as Eddie Murphy in New York, and they started in the same nightclub, same week. Two of the biggest legends, comedic legends, started their careers at the same time, around the same age. They were both like Eddie Murphy was 18 and Jerry Seinfeld was around that age. So interesting.
Yeah, that's interesting. Yeah. Eddie Murphy, he's great. He's kind of like stepped away from like the limelight, it seems, but he was great in the 80s when he was more active. It seems like he doesn't
Yeah, he
really
did a
do
lot of
anymore.
movies, and then he got into kids movies. He's the voice of Shrek, right? He's the donkey, and man,
Oh, right. Yeah.
I think Eddie Murphy's been in 200 movies, probably 50 blockbusters, and then he's stand up. Remember Delirious and Raw?
I saw it in the movie theaters.
He was doing what comedians do today, like with the whole Netflix kind of, they do a live stand-up act for Netflix. He was doing that 40 years ago, 50 years ago. I'm going to say 40 years ago. And he was getting, I mean, people would pay to buy the VCR cassettes, and he made it successful back in that era. And now that you have Netflix, which makes it easy, you can see Chappelle and other comedians do their thing. All right.
Yeah.
So,
No, he was good. I'm a big fan of SNL. So he was pretty big on SNL in the early 80s.
Okay. So I'm trying to keep up with the comments, and hopefully I'm not missing anybody. I apologize if I did. So XOM is ExxonMobil. Any comments on ExxonMobil? Are you an oil guy?
Yeah. So oil is up about almost 15% in the past month. I think a barrel is now $70. Mid-70s. And just a month ago, September, it was like what, 58?
It got down to 60, low 60s. I follow it. I own Chevron and I follow oil.
Okay,
so we're mid-70s right now, and then we got down to like $62 a barrel. And you're right that it went up substantially over the last month, and oil companies have really benefited from that.
So oil, there's potential for oil to get back up to $100 a barrel, and that's a concern because oil has a huge trickle-down effect into everything, because if it costs more money to ship products, then pretty much every business charges more money. Like a supermarket, a lot of they, if they're charged, instead of $1,000 to move a truck of product, they charge $2,000. So they have to pass that cost on to us. Airlines get killed with higher oil prices. But the great thing is that we really change tides, because we were so reliant on the Middle East for the longest time. Now we got into kind of like fracking, figuring out how to create oil besides having oil reserves, which is the main way. I mean, we have them in Texas, of course, but we didn't have enough to fuel our economy. But now we pretty much do. We generate more oil. We
export oil right now.
So yeah, we export it. So
so in the early 70s, the early 70s, right? We got caught in a situation where the Middle Eastern oil was so easy to extract, and it was so much easier just to bring the oil, that the complex got a little bit lazy. And then that happened, right? The oil embargo, and it was very painful for the economy. It put us into a tailspin. Now, fast forward, more recently in the last 20 years, we did see oil at like $150 a barrel. Whew, it's a lot of money. And this is like 15 years ago. Yeah, about 17, 18 years ago. So fracking, the oil was always here, but they couldn't get it out. And it's caught in shale. It's also caught in sand. And they couldn't extract it very easily, but they developed techniques to do fracturing. The street name is fracking. And they're able to extract the oil. But the oil price needs to be above like $60 a barrel in order for that process to be profitable. Once you get oil above, 70 for sure, there's a lot of fracking going on. And then the fracking, the positive is that it's extracted domestically, and then you can put it to the refineries who then create petroleum products. So yeah, now we export oil because we are fracking at a very high rate and can put the oil and sell it to other countries. So
Yeah, the
I
advances in oil production just in the past 2 decades are massive.
Yeah, and there is naturally an oligopoly in this industry. Exxon, Chevron, British Petroleum, Shell, they already have the rights to, like, the whole planet is kind of covered. Like, somebody has a right to extract oil on every square mile of Earth. So there's kind of a natural oligopoly. Now, what I would say is, I don't own Exxon. I own Chevron, and I'm not happy with my rate of return.
Are you looking at
32% over 5 years with a dividend that's been good. If you add the dividend,
Yeah, if you got
up to like 55, 60%. But I'm unhappy with it, especially this past 2 years. Look at this. I'm like just bumping along, barely even. I'm up like 10%. Thank God, because I bought shares back here, and I've owned shares for a long time. So,
but you got to compound that dividend. It's usually higher. What's the yield now for 5%?
4.31.
Okay, so yeah, when you kind of compound that in, because some people look at a stock over the past 20 years and it's flat, and I'm saying you're not flat. You're up like 100%, because if you get a 5% dividend, and that's you have to compound it. Yeah.
But just compared, I mean, it's good to have an oil company because it tends to do well when everything else is doing terrible. Like in 2022, this one did great. Here's a 2022 chart, right? Okay, great. This is the one stock that was really good. I own like $100,000 of Chevron, and I just sold, which leads me to a topic that somebody brought up. So the topic is, do you sell covered calls on your positions? Because the question came up, and
we've done it in the past.
I forgot who asked, but I'm just going to get back to the question.
Shadow Guy, maybe?
No, it was somebody else. I know.
Covered calls. I did it. I used to do it when I learned about it. But if anybody's saying
it was Stink Bid. Stink Bid brought it up.
People generally don't, who make good money in the market, don't do stuff like that. And if somebody says, "Oh, I've made so much covered calls," because they want to get a lot of views on a channel, I'd like to see some proof. I question anyone who says that. But you don't trade options though, right?
So I sell covered calls, and I'll tell you in situations where I'm willing to sell covered calls. For example, Chevron, which I sold a covered call that was in the money yesterday, and 100 shares were called away. And when I look at Chevron, it was a stock that wasn't really moving, and I feel like I have too much Chevron in my portfolio. I see other energy companies, and this call got, shares got called away. Now, I'm not like crying in my coffee here, because they were called away at $150 per share. I got paid a premium, so I lost like $50, $75. But since I sold this call, the stock has gone up nicely, like 8-9% on a $100,000 investment. So I'm good. I hope I could do that to every one of my stocks, is sell a covered call and then your shares go up 8% in a month's time. Yeah, I'm good with that. So in this case here, I'm willing to let go of some shares. I'd like to thin, the investment. Now, if it wasn't in the money, I would just keep the premium, and I'd probably roll it over after their earnings. I don't want to have an open option during their earnings, and I think they're going to announce in a couple of weeks. So that's where I would sell a covered call. I don't do a whole lot of it. I think I got burned on one occasion, and it was probably a couple $1,000 loss because the stock went up so fast and then I had to sell it at basically a discount to the share price. And that one made me aware that, hey, these things are risky.
Well, you just got it called away, right? You didn't have to sell it. They just took it, right?
Right.
If it was
It's
called.
automatically 100 shares were sold
Yeah, without,
automatically. And
and
I
then you
get the
don't.
cash. I get the cash,
Okay,
100
exactly.
shares times $150. And I'm better for, I mean, I'm further ahead because the stock did perform. And I've got a couple of other open, like I sold options on Allstate, and that's going to do fine. It's not going to be in the money. And a couple of others like Amazon. I sold puts on Amazon because I want to accumulate that stock, and I'm willing to sell puts. They're probably not going to be in the money, so I'll just keep the premium. In the meantime, I just keep buying more Amazon.
Right.
So that's how I use options. But it is a situation too where when do I buy options? If there's nothing better to do, and I'll show you a graph here. Look at the returns we have 1 year. Technology's up 69% as a whole sector. Communication services is up 41. Financials up 40%. Okay. The market to me seems expensive. It's hard to find discounted stocks. So yeah, I'm willing to dabble a little bit in options just to see if I can make a little extra income because, the latest kind of trade that makes sense to me, it's China. So I'm been buying into China, but everywhere else in the US, it's really hard to find an obvious, that stock seems really discounted and I want to jump in head first.
Yeah, yeah. You generally with options, if you're selling covered calls, the premium you make is usually minuscule compared to the risk, and so you make a couple $100, $500, with the risk of potentially losing thousands. And then if it gets called away, that pretty much wipes out all your gains for the past few years of covered calls. So that's why I just don't see that. I don't see how anybody can make money that way unless you're doing it as a hedging strategy. Like you don't want to sell the stock, but you have too much of it, so you're concerned if it's going to go down. So
you can play both sides. You
could, yeah.
You think it's overpriced, so you're like, hey, I'm willing to let go of some shares if it goes up more. And then if you think it's discounted substantially, you could say I'd rather sell some puts. And if it goes down even further, I would have bought the shares anyway. So I'm good to go. So that's kind of like the conservative way of playing options. Then there's super high risk options where it's either you make money or you lose your whole investment. I don't play that game. I sell covered calls. I sell covered puts, and that's to the extent of it. And I don't do a whole lot of it.
Yeah. Yeah. You don't want to sell uncovered calls. You can lose everything. But
go ahead.
I recommend if you think a stock will go down, don't sell covered calls. Sell the stock, because if the stock goes down 15%, yay! I made $80 on my covered call and lost 8,000 on the stock going down. So just sell the stock. There's no reason to. I mean, you could do what you just said, but that could get pretty complicated. And like if a stock you're really bearish, just sell it. And if you're really bullish, don't do a covered call.
Yeah. I agree with that thinking, which is one of the things, just to put a final brick on that wall, is investing is already incredibly difficult. To find winning stocks that are going to perform for the next 5 years, it takes a lot of research, a lot of thought, and decision making and risk taking. It's already really hard. And I think once you mix in options, in a way, you're making it more complex. I don't like mixing in too many options because it makes it too overly complex for me. And it's already hard enough. It's like I'd rather sit back and see where stocks go and continue to analyze the companies that I own to see if there's a company like Intel. I mean, that one was obvious. That thing's a hot mess. And that one was the one that probably was the biggest loser for me in 2024. Here's an interesting request from Alarindi Hay, and I apologize for mispronouncing it. Kava versus Chipotle. This is a cage match of the food companies.
Yeah.
For the 1 year, Kava is just on fire. And then Chipotle is getting it done at 63%. Go ahead.
Yeah. Kava is probably not as well known as Chipotle, but they acquired Zoe's Kitchen. So they're really focused on Mediterranean fast food. So this, and Chipotle is just kind of like a giant. Like they did that 50-for-1 reverse regular stock split, and they perform so well, and it kind of kills me. It's like, oh, why didn't I invest in Chipotle? But hindsight's 2020.
Yeah, I've owned Chipotle in the past, and haven't owned it in the last 5 years. The one thing that got interesting for me, if you can see my screen, is they lost their CEO. I happen to believe, like Warren Buffett and other investors, based on the books they've written, is it's not about the CEO. The value of the business is what I should focus on. If a business is super valuable, like Google Alphabet, the founders are no longer active in the business. And then the second CEO is Eric Schmidt, who was really the CEO that took them to the promised land. He left. Now they're on to the next guy. Google Alphabet's going to be fine. It's a super valuable business. Apple, Steve Jobs is gone. Well, some guy just got to take over the steering wheel and steer the ship. So when I saw that they lost their CEO, I thought it was an opportunity. I did evaluate the stock. It wasn't good enough. I don't like restaurants. I don't think they're a great business. And the stock hasn't really gone up a whole lot. The market has been going up nicely, but that was a big shakeup in Chipotle. Our friends at Kava, they're doing really well. Over the 1 year, just up dynamically. Look at that chart. Holy smokes. This is a small cap, 15 billion, excuse me. And they do 845 million in revenue.
Yeah,
they're not growing that fast. Why are these companies tripling in value and they have like 30% growth?
That's the thing with the stock market. You can't wait for them to grow. Like Tesla and Amazon stock was going through the roof while they were losing a ton of money. So if you waited for them to become profitable, you would have got crushed with Tesla, because if you waited for them to become profitable, you would end up losing 50% of your investment. Because by the time they kind of peaked, the stock was already at such a high level. So you have to kind of like do this stuff beforehand, which is hard to do, right? How do you look at the financials for this company and say, oh, this is a good investment?
So Kava, are they profitable? They do make money. They've made money. They made money in 2023, and the trailing 12 months is even getting better. So they're making $42 million.
Well, they have negative cash flow, though.
Do they? Okay.
Well, now it's, at least in 2023. Now it's probably positive a little bit.
Yeah, $11 million of free cash flow in the trailing 12 months.
So
that's that's a turn in the right direction. Now, I'm going to go back to like one of the philosophical investing rules that I like to follow is, there's certain industries that I just don't believe are very valuable. Airlines, I thought I would ignore what Warren Buffett said about airlines, and I've invested in United, and I was unsatisfied with that return because just people don't want to buy airlines. And I don't want to buy restaurants. They're expensive to run. You have a lot of employees. You have ingredients. Spoil. You have to lease out space, which is expensive. Once you add it all up, it's like, well, I'd rather buy Meta. They have like 85% gross margins. They don't have to do any of that. I'd rather buy Robinhood. They're a completely digital company. They don't have to do any of that. It's a choice. Like we have thousands of stocks to pick from. There's no rule I have to invest in them. So just from the get-go, I don't like restaurants. The exception was Starbucks, because they're more of a coffee kind of oriented establishment. And that worked out nicely, but that's the only restaurant I've owned in the last couple of years. So I'm like a bear to begin with, and Kava looks like it's really working for investors.
Yeah. An alternative to a restaurant, McDonald's, even though it's a restaurant, it's really just collects royalties from its franchisees. It doesn't really operate any McDonald's. It's all franchised out, and they just collect, like 8% off the top. Plus, they have a real estate division. But that's probably more of a valuation thing because it's been around so long. It's probably you're not going to make a 10x return like you will with Kava.
Kava, yeah.
Go
Kava. I don't know that there's a Kava near me. I don't think I've never eaten at one.
I've never seen.
They're headquartered in Washington D.C., so maybe they're starting in D.C. and I'm in California, as I think you are, and I think it's going to be a little while before we get to enjoy it. All right. Well,
there is actually there's actually a decent amount in California, maybe like 25, 30. You have Anaheim, Brea, Burbank, LA, Chino Hills. It's probably in malls, like the food court in a mall. And I bet you've passed it like a dozen times and you didn't even notice it.
Right.
That's what I do all the time. I could go to a shopping center for a decade and never even know a certain store is there until I need something at that store and Google it. I'm like, oh, it's in that shopping center.
So since we're talking about restaurants, I'll tell you the restaurant that I've run into in the last year that I think is really good. It's called the Kebab Guys. It's kind of got a Mediterranean menu to it. They started in San Diego and they make very good Mediterranean food. And they basically make, if you think of a burrito, but they put Mediterranean ingredients in it with like the meat that they put on that big skewer thingy, and the food's really good. And that's one of our family's favorite. I think I don't know if it's similar to Kava, but the Kebab Guys is not a public company yet. They started in San Diego. They probably have like 50 to 60 restaurants to this point.
Oh, wow.
Have you run into restaurants that you like recently, or a new one that?
Yeah, I'm not a big fan either of the space. I just think retail is so rough, and it's always going to be around, but I don't see the returns as nice as tech company. So yeah, I don't really. I kind of regret not going to Chipotle because I used to go there every day for lunch, but yeah, I don't have any.
But it's just like I own Chipotle, and this is a number of years back, like 5 or 7 or 8 years back. If you recall, they were having a lot of trouble with food poisoning. Like their lettuce was getting to meals that people would eat, and it had whatever contaminant, and people were dying. Like they were getting really sick. That was a big problem. Well, that's what you get in restaurants is like Facebook has their set of problems, Microsoft has their set of problems, but most definitely restaurants, they have, not only do they have to get fresh ingredients, cook them up, serve them if you want to grow, you got to throw a ton of capital at your business, just on and on. It's like, okay, I'd rather not be in that business. The intrinsic value of that business is not very high.
Yeah. It's a lot of things to battle. Actually, the company I'm at, we just opened a Habit burger in Nevada.
I like the Habit.
Yeah, Habit's good. So that's, Yum is the parent of Habit. So Yum is a publicly traded company. They own
Taco Bell. They own
Wingstop, is it?
They own Pizza Hut and KFC, correct?
Yeah, I think that sounds right. I thought Wingstop, but I can't. Yum. They also have Yum China. KFC, Pizza Hut, Taco Bell, The Habit. No, they don't owe Wingstop. What was I thinking?
So one of my sons, I believe it's in Japan or Korea. He educated me and he said, for the holidays, people celebrate by getting KFC for the holiday meal. Like, you know how we have Thanksgiving and, you know, in my
That's so
case,
funny.
I celebrate Christmas or Christmas Eve and,
Wow. Yeah.
you know, different cultures and religions, you know, celebrate something. Well, I forgot if it was Japan or Korea. They love KFC to the point where they're like, okay, KFC has to prepare for that holiday because everybody orders it.
That's funny. KFC. It's a specialty, I guess. And
So okay, we got our man in Switzerland who has a friend in San Diego. Says that there's at least one kava down there. Okay. See, I'm in Orange County. I'm just north of San Diego. I haven't seen a kava. If I do, I'm going to have to try it and
yeah, I
help
think
them
there's
with their growth rate.
a few near you. You just probably never went there. It's
I have a list of restaurants I got to hit. You know, one of them that you ever been to? What's that place in Chicago? It's that makes the Italian sandwiches with the sliced beef.
oh, like the cheesesteak?
No, that's Philly. It's not Portillo's. It's I forgot the name, but they opened one in Buena Park, and I gotta try to get there because I love those sandwiches in Chicago. So, anybody that's out of Chicago, you know what I'm talking about. These Italian sandwiches. There's a location that's been there forever. Everything in Chicago that's meat oriented, steaks, hot dogs, it's like insanely good. They know how to cook steak. And they know how to cook steak in different places. Then if you're in Kansas City, their barbecue's off the charts. Texas has their barbecues off the charts. I've never been to South Carolina, but I've heard that it's really good. All right,
Yeah.
so let's get off of the food train and talk stocks. Although food is fun to talk about. All right, so let me ask you about China.
That's a good one. Because
what do you think is going to happen? You know, give me the big picture. Do you think this trade has legs? Is it going to last for a while? And then we'll start there.
So China, so just here's some like high level points. So the S&P is up almost 300% since 2007. So the past 17 years up 300%, and China is down 50% in the past 17 years. So it's just terrible, performing terrible. If you want to compare them, like the FXI is like the equivalent of the S&P 500. The FXI is like the large cap Chinese index. But they've really making an effort to stimulate the economy by similar to what we're doing, or I guess any economy would do, any government would be to inject money into the economy and potentially lower interest rates. So there's been a lot of positive trending with the Chinese stocks the past few months. I do think it's gonna continue because it was lagging for like a long time. I mean, remember when like all those Chinese stocks like Alibaba and those
So I
other
have
big
Alibaba and Amazon on the chart that you're seeing on the screen.
Yeah, I mean Alibaba, which is a really profitable company, tons of cash flow, and they were just tanking, going down, and it went down to like lower than its IPO levels at some point. It was down to like $65 a share or something at its low point. And what was it like to peak? Like 300.
Yep.
And you're not talking about a company that's like losing money or has a weak business model. You're talking about a extremely profitable. So it's just nuts. And a lot of Chinese stocks have gotten crushed. And it's not because the companies are doing poorly. It has really nothing to do with the companies. It's the risk of being in China. And the Chinese government makes it hard for non-Chinese companies to come into their country and set up shop and do business. Especially American companies. They will not want a big American company coming in and selling their products, which is like, we welcome that. We welcome other countries' money. We welcome other countries to come into our country and help the economy. They're so against it. But I think what's his name? Xu Jinping, something like that.
Mm-hmm.
He's kind of turning it around. Xu Jinping. Yeah. I think he's trying to get a little more into capitalism and help stimulate. So that's why we saw upside. But when you look at like valuation, it's such a low value. The upside is so extreme if it does go up. And I do think there's a potential to triple your investment over the next 3 years if you invest in China.
I agree. And I'm going to come at it from a different perspective, right? Because I think you covered that perspective quite well. Is if you look at the China economy as a whole, it's the second biggest economy on earth, second to the US, but it's growing at 5% and we grow at 2%. At some point, it's going to be bigger than the US. When you have GDP growth of 5% on a massive economy, that's a lot of organic growth for the companies that are operating in that economy. So very high level, it's going to be a good economy in China for the next 2 years. Having said that, back to your point on Alibaba, the stock has been sold off massively, right? And you would think, okay, well, did revenues have gone up during that time? So that's weird. You can buy the company at a fraction of what they were selling 3-4 years ago, but the company's bigger with more customers, with greater power, because 3-4 years ago, cloud businesses were valuable, but they're not as valuable as they are today. And I like how you covered in your video on your channel that Alibaba has a cloud business. Alibaba, and in general,
the 4th largest in cloud company.
Yeah, I was going to say that a general observation is that it seems like they copy everything Amazon's doing. Amazon has an e-commerce business. They have that. Amazon has a cloud business. They have that. It's like, everything Amazon does. Yeah. Copy somebody who's really good. So having said that, if you think about back to the comment you just made, which is, the China government is going to be very uncomfortable if American firms like AWS or Microsoft are in China saying, hey, give us all your enterprise workloads and we'll manage your data. The government's going to be like, no, we want a Chinese company, Alibaba, to manage all those workloads and have access to that data, because they really don't have access to the data because the hyperscalers pretty much are like hands off. But even the possession is something the Chinese government, as well as the American government, right? I don't think the American government wants big workloads of US data on Chinese servers. So I think all that put together, and the disparity between, like, here's Amazon and Alibaba, two very similar businesses in the two biggest economies on earth, the disparity in the valuations that, have resulted over the last 4 years, there's a lot of upside for Alibaba just to get back to the halfway point. If they get to the halfway point, this thing's 100% winner in 2025 or more. And they just have to get to half of the value they lost compared to Amazon.
Yeah. I mean, they were over 300 at the peak, and they IPO'd under 100, and now they're down to, I mean, the low was like, I think it was the high 50s, possibly the low. It's coming up. The past month, Chinese market is killing it, up 50%. So the trend is your friend. So I think that it's trending up, the Chinese market, and I think it's a massive upside potential because there's so many people, and
Yeah,
they
it's up
have
31% in 3 weeks.
yeah.
Nice.
I wrote this down. They have a ton of money sitting on the sidelines in China, like multiple trillions of dollars sitting in, bank accounts, sitting in money markets that could be invested. But they're really heavy in real estate. Most Chinese people buy homes like that instead of putting it to the market. But when you don't have extra money, you can't. You need to live. You need food, and you need to live. So that's where a lot of the money goes. Because generally, there's not as many percentage-wise, of course. There's not as many upper class people or even middle class in China. A lot of people are in the lower class level. Of course, some in poverty level, but
I would say that I would say that one thing I'd point out is they have so many people that the number of people entering the middle class is substantial. You follow me? It's kind of like the whole population is not going to be middle class. Like here in the US or like countries like Switzerland, especially Switzerland, I think 90% of people in Switzerland are middle class or higher. That's a guesstimate. Didn't come from any like credible source. But in the US, I think a good portion is either middle class or wealthy. In China, even though maybe only 20% of their population is entering the middle class or is in the middle class, that's a huge number because there's so many people there. So that's one thing to consider is, well, that means that they're really interested in EVs. So the EV market's exploding. Like so many cars are being sold. You have iPhones that are selling, like in China, they sell a lot of iPhones because even though a lower percentage compared to the US is in the middle class, their population is so massive, it's still a massive number.
There's so many people moving between classes from poverty to lower class, from lower to middle, and middle to upper. And when you move $100 million people into those different classes, those 100+ million people want to buy a nicer home, want to buy a nicer car, want to eat out more, things like that. So that's why the economy grew so much in the 80s and 90s, because you had so many people and a president, or I don't know, I don't think he's called president, but whatever the head person.
Yeah,
was into capitalism.
He's not a prime minister. He's the head guy. He's the equivalent to our president. Yeah, but he doesn't have it. Their terms are different. I don't quite know enough to even provide a comment, but I think so. Your conclusion that the China trade has legs, I believe the same. It's not going to be a smooth ride, right? I think it's going to be a little bit of a up and down process, but I think we're going to be sitting like at the Alibaba stock. I would not be surprised if it's a 50% gainer in 2025 or better. And a lot of the other stocks too, because it's almost, the inflows, now that China is really moving, Bloomberg has a really good program. It's called the China Report, and they really focus on China, and they play it like 10 p.m. Pacific. So I usually watch it when I wake up, and wake up whenever, and then I watch that, and they showed that the inflows into stocks right now is triple the volume than the inflows into the S&P. So the inflows into Chinese stocks is, from a US dollar measure, is 3x the S&P. There's a lot of money going into China. If that continues, there's no way it's going to go down. It's going to just continue to rise if they continue to get those inflows. But that's going to be the trade that I follow, because I think I talked earlier that it's hard to find discounted companies, but it's easy to find them in China.
Really easy in China. Pretty much every stock except PDD, which is doing amazing past few years. Yeah, yeah. But then you got to like weigh like, do I want that risk? Because sometimes I invest in like other countries or small caps, and then 5 years later I'm like, okay, I'm still flat, or even worse, I'm down 50%. Then I'm like, when am I gonna just put into something that's gone up? So it's so
time
hard.
check. Time check. How much time do you have left?
Yeah, I'm good if you want to do another 10, 15 minutes, or
Okay.
if you need to go.
This has been a lot of fun. It doesn't feel like we've been going for an hour and a half. It feels like we just been talking for 20 minutes, but I think because we talked so much about food, which is, I'm a fan of food, and talked about Eddie Murphy, and we have Jerry Seinfeld on the live stream. That doesn't happen every day. So it's been fun.
I know. You draw a pretty important crowd.
So one of our guys, I think Trey Greenfield in Kansas City, who believes Kansas City barbecue is the best. I've had Kansas City barbecue.
I've heard that.
Awesome. It's like game changer. My head exploded. Whenever I go to Kansas City, my mouth waters going to Kansas City. It's really good. And if you're ever in LA, you got to have really good Mexican food, because we rock when it comes to Mexican food, among other menu items. All right. So AppLovin is the company that he wants to take a look at. AppLovin Corporation engages in building a software-based platform for advertisers to enhance the marketing and monetization of their content in the United States and internationally. So they are 49 billion market cap, 4 billion in revenue, PE of 62, 37 forward PE. So they're basically taking like a company that says, hey, I want to advertise on Meta and YouTube and Netflix and Amazon Prime Video, and how can I optimize my spend and get the best ROI kind of solution.
Yeah. So they give people who want to develop apps, they kind of have that infrastructure in place. So if you want to make your own app or market it, you go to AppLovin and they'll help you. Kind of like GoDaddy made it so easy for people to get their own website. Because before, like services like GoDaddy, a lot of people didn't understand how to get a website. It was very complex and foreign. Now it's so simple. So if you want an app, go to AppLovin. Kind of like stock market in the early 90s, like it was very difficult to trade stocks.
Mm-hmm.
You didn't know what you were doing, but once E-Trade came out and companies like that, it kind of brought into the mainstream.
So these guys are like, you could just kind of develop something very quickly, and then you're off to the races. Oh, very cool.
I have a question, Trey Greenleaf. So when you say Kansas City, is it assumed it's Missouri? Because whenever I hear Kansas City, I just assume it's Missouri, because isn't that the main Kansas City? Yeah. Because that's where the sports teams play. That's why I think of Missouri. And a lot of people, I think, assume it's Kansas. Even though I get it, there is Kansas City, Kansas. But isn't that kind of like not as
small? Yeah, the Kansas City is in Missouri, or Missouri. I'm not sure when I'm supposed to use one or the other. And then on the Kansas side, I've been to Overland Park, and I've been to Leawood. It's a really nice area, man. It looks like freaking Irvine, and it's really nice. And the barbecue's in the Missouri side. Joe's Barbecue.
They don't.
That's somebody who lives there told me go there, and it's good because you get there and it's a long line, and all locals get in line. Takes 15, 20 minutes to get your food, and then my favorite was burnt ends. But everything was good, and it's a simple menu. It's like In-N-Out Burger. Here's what we serve. It's all super delicious. Go ahead and eat it.
I think, is that like the dead center of the U.S., Kansas City? It's like right in the middle.
Yeah, it could be.
If anybody, is that what you're known for being the exact center? I'm just looking at a map. I don't know if it is.
One thing I've noticed when I'm in Kansas City is there's a lot of rail yards. And maybe that's why they got their hands on so much beef, is I think there is the rail lines use that as a big hub, and I think that's why it's developed into a big city. And of course, they have the Kansas City Chiefs, and they have Taylor Swift barnstorming the NFL games nowadays.
The Royals.
Yeah, the Orioles got eliminated by the Yankees, so that's kind of a little bit of negative news. So Trader Pratt is on. How you doing, Trader Pratt? He's he also streams, and he's a trader, really good trader, by the way. He streams every evening at 8 p.m. Eastern.
We should do a live stream, Trader Pratt, 3-person live stream.
Yeah,
yeah. Victor.
I'd love to. Like we got different angles, but you and I are kind of like on the long-term investor side. It's good to see like a trader that says, well, there's very little I can do with that stock, or I love that stock because it does this or that. I like getting that from him. So Frank wants to talk about Zim. So I don't know if we finished on AppLovin though. Hold on, let me pump the brakes there. So I didn't have an opinion on AppLovin. It looks really interesting as a business. What are your thoughts on AppLovin?
The first thing I do when I invest in a stock is my main decision when investing in a stock. Of course, there's like 1,000 things I do, but number one is I try to understand what the company does and see if it kind of makes sense. So like there's companies. Oh shit, I can't remember the name now. What's that company that does the weird big data?
Palantir?
It is Palantir, yeah.
Yeah.
I'm like,
or Snowflake. Snowflake does like big data
analytics, yeah.
Well, they do the more like not the data warehouse, but data. They have the data infrastructure for you then to do the analytics. Palantir isn't a big data analytics company that's trying to find patterns in the data, and they help like the military and stuff.
Yeah, I know Palantir was big in the U.S. government space. That was on my list to talk about. Maybe I'll do a live stream later. I feel like I haven't done one in like almost a month. There's so many things to talk about. That stock is doing really well.
It is.
What were we talking about?
AppLovin.
So when I think of it, and I really haven't. I don't think I've heard of this company till today. I don't think I've ever even looked at it. But
yeah, I haven't looked at it.
Just thinking about it, it makes a lot of sense to me because people think of just like the websites. I remember building websites in the 90s, real basic websites, but people are like, oh my God, how do you do this? But I'm like, it's so easy. But like building an app, like it sounds so complex. It sounds like you have to be this like great, software engineer, or like you have to have this, be able to like write code, but it's not that hard. And when you have a service like this, so just the idea of it makes a lot of sense to me. And apps are kind of like taking over.
Look at YouTube, right? Like 30 years ago, if they would have told me, yeah, someday you're going to be creating videos, broadcasting them to a global audience. There's people in Europe, South Africa. I've got people like in South America, India, China, Japan, and you're going to be doing live streams with another streamer that's not located in your office. I would have been like, yeah, you're out of your mind. I can never imagine that future. And now it's like easy. It's like, boom.
Like, how do you even do that? It sounds, if you ask someone who's I don't know if many people don't know how to do this, but if you ask someone who's not very tech savvy to do exactly what we're doing, they're like, there's no way I could figure that out. But it's so simple. It's almost like you don't have to do anything. It's really pressing a few buttons.
So AppLovin looks like, what's interesting about their chart, right, is I think they IPO'd
let's
like
go back to
4 years ago. And you look at their chart and you're like, okay, the market loved them, didn't want anything to do with them. They sold it off by 91%. And then people that bought in are up 1,412%.
Wow. So yeah, it was $100 at the end of 2021. Then it fell to $10.
Amazing.
in the beginning of 2023. Now it's back. Now it's up to almost 150.
Yeah. I
It's
mean,
all
you look
high.
at it's a real business, right? And I like their idea. It's unique. They're growing really nicely. Okay. Looks good. Are they profitable?
They have positive free cash flow every year. They have
Wow.
positive free cash flow,
Crazy.
which is amazing. Which is really amazing.
How did I not find this company before?
There's so many companies, and even if someone throws in your face saying you got to look at the stock, it's kind of like
Look at this cash flow.
there's so many
Crazy.
stocks to look at.
Look how smooth this data is. Up, 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 up. And it keeps and it's
so
accelerating.
$1 billion, $1.5 billion of free cash flow in trailing 12 months with $4 billion of revenue. They're like a really
This
good
company
margin.
is going to be acquired by Google, Microsoft, not Meta. So one of the big guys, maybe even Adobe, is going to acquire this company.
Like 49 billion is a rounding error for Google.
Microsoft could be like, "Hey, look, we're going to buy your company. We have the cash. You good with it? Okay, here it is."
Yeah. So I haven't looked at the space too much, like like companies that support app developers, competitors too. Is this the biggest one, or is there?
Well, I think they have a unique proposition, right? Like what I'm understanding is that's a pretty unique proposition where you can very effectively go from idea to the apps running. Like, hey, I think my customers would like this app. Boom, create it. And the ideation cycle is really short now with a company like this. It's almost, like YouTube, right? YouTube doesn't have to film one video. They have everybody else do it. And that's very powerful. The same thing with like Uber. They don't have to drive one car. They don't even have to buy one car. All their drivers do. So it's very powerful. AppLovin is like, we don't have to develop one string of code other than our platform, because everybody's coming on the platform is developing. And as they develop, we get bigger. Our whole enterprise gets bigger. I like those businesses.
And yeah, I look for, companies that make sense. I look at scalability. It makes a lot of sense to me because apps, in like 2003, I was like, who cares about these apps? Like everybody's using their PC in their home. Laptops weren't even that popular, and they were just going to websites. Websites are amazing. Like, why would anybody not use a website? But now, like, I'm on my phone a lot of times.
Yeah.
I'm not going to go to a website. It's just so much easier to open an app that's specialized for that particular. But yeah, that's cool.
All right. So AppLovin's looking great. Whoever I think is our Kansas City guy, Trey.
Oh, they got their name. I was thinking McLovin when you said AppLovin. I was like, this is a joke. But they
McLovin?
they got their name. Oh no, that's just AppLovin name is from BlogLovin, a content organizing company, contrary to reports of a homage to the character from Superbad. Okay, so it's not actually from Superbad, because that's what I thought of when I heard AppLovin. Did you see Superbad?
I'm gonna look at AppLovin closely, and I've already. That's one of the things that I really like about the live streams, and is that we cover a lot of ground, right? And usually people show up to these with like, hey, I think this company is a good one. Let's talk about it. So it's almost like a force of, there's 29 people attending the live stream that I could see. It's 30 with us added to it. It's 32 people or 31 people that are collectively bringing up ideas. And AppLovin's probably the interesting idea. I don't know if it's worth buying into it. It might be worth watching it and waiting for it to settle down a bit, especially since their earnings are going to be November 6th, right? But for sure, I'm going to check them out because I'm thinking of creating a couple apps. And
wow, really?
yeah, I wanted to I wanted to put my model in an app and then offer it up to people. Hey, you want to use the app? So we'll see. We'll see. I've done in my career. I've done big software, big
Okay.
software projects, but this little apps is something I've never touched.
Yeah, I looked into somebody helping me build a website to do a DCF model, but it's not that hard. But it's like, do I want to like try to stress and think about it and do it? I probably could learn it, but I feel like it's not going to be that good. So that's why I wanted to like have someone.
Yeah. Yeah, I know it. I know what you mean. So let's kind of end the stream with Zim, which is a stock that somebody asked about Zim.
Yeah.
So Zim's a stock you've covered. I've covered. I've invested in Zim. I sold my Zim shares in the last month. I kind of felt like I was abandoning the team, so to speak, because I was kind of getting along with a lot of people on Reddit over Zim. I really root for the company, but I just felt like, you know what, it's getting riskier, and I've already got at that point I had a 50% return, and I've owned the stock for like I think it was 8 or 10 months, and I'm like, okay, I'm good. This is not a stock that I had planned. Oh, I'm going to own it for 10 years. No way. I think shipping rates are volatile. They go up, they go down. And I bought the stock because it was overly sold. Too many investors were like, this company is worthless. And I'm like, no, it's worth something. Why isn't my computer working? There we go. So I bought in, I got out, and then it had a pretty big crash recently. I don't know why. But have you kept up with Zim?
No. I used to do a lot of videos on it, but I haven't looked at it in a few months. I know it's come back quite a bit. Shipping rates. Well, I mean, higher oil prices is not good for Zim because a bulk of their expenses is the oil to move the vessels. But it's. I think it was so oversold, and you made a good entry point.
Yeah, I bought back here, and I sold here, and for a couple of weeks, I'm like, well, that's what happens, right? I got out of the position, and I'm not going to cry about it because I made money. I made a substantial gain over a short period of time, and then it settled back down. And this stock has done that before. One thing, you see these pops and drops. Pop, drop, went up. But in general, look at the stock over the last 5 years. The market was like, oh, yeah, it's an $84 stock. And then it sold it off 92%. It's only worth 8 cents on the dollar, even though they bought a bunch of new ships with all the money they were making when we had the supply chain issues. So I thought that was an opportunity. That's when I started to buy. And it turned out okay.
Yeah.
I think if I look at Zim, it's going to value higher than this amount. If you look at their free cash flow, they have a nice dividend. But it's like something that you said earlier about industries, right? Some industries, investors, you're going to have a lot of investors wanting to buy Apple, wanting to buy, fill in the blank. And then when you go to shipping, there's a lot of like pessimistic thinking, like, oh, well, it's going to have hard times. And there's not as many buyers. So it's not a company I see is going to rally for a long time and have a sustainable rally. And that's why I was like, okay, I made my money. I want more cash. I continue to think the stock market's priced too high. And that's why I exited. I still think the company's great. I could see the stock continuing to work. I had intended on keeping it till it was $30 a share, but I just reassessed everything 2 months ago and said, I want more cash. And Zim was voted off my portfolio by my one-person investment committee.
It's that's a good one to take off the table. It's so volatile shipping. So I'm trying to look who's the there's an index I used to look at for shipping rates.
Yeah, I track that as well. I forgot you know what? There's a Reddit thread that's really good. And on that Reddit thread, if you just search Zim on Reddit, the people that are on that thread, if you'll constantly be informed on shipping rates and what's happening in the whole industry. That's a really good thread. If you're not on it already, I recommend you consider it.
So, it's okay. I don't use Reddit much, but I did do a video on Reddit stock. Does anybody know that the index that tracks shipping rates? I can't remember it, and I can't find it in my notes.
Yeah, I want to say it's God, I forgot the name of it, but it's killing me.
I don't know why it's not in my notes.
So here's the Reddit thread I'm referring to. Where did it go? So here's the thread I'm referring to, Zim on Reddit. And I mean, just constantly you're getting really good data. And these guys are going after the
Baltic Dry Index. That's it.
Baltic. Yeah, that's it.
You just
I couldn't remember, but that's the right name. Correct.
Yeah, that's what I used to always talk about in my videos.
Mm-hmm.
It tracks the routes for, I think, the 20 common shipping routes.
Mm-hmm.
So, and then it's kind of like, the S&P 500. It doesn't mean every stock moves with the S&P 500. Just an average of the 500 biggest stocks. The Baltic Dry Index is just an average of certain routes. Obviously, some rates are going to be lower or higher than the index.
Yeah. So my opinion on Zim is it's, if you think the stock's going to work, I think the fundamentals support the stock price. They actually show that the stock price is discounted. Free cash flows there. They pay a dividend. The one thing I would complain about is the government in Israel took a nice piece of my dividend and I got a portion of it. I think I ended up with 75% of the dividend.
Somebody said Zim got hit. 4 ships got hit by a missile. That's I didn't hear that.
You know where I would get that is this thread, man. Like everything that happens to Zim, it's on here. And I'm not seeing that. I'm not seeing that story.
Vessel hit by missile in Gulf of Aden. Do you happen to know the container freight which makes Zim profit? Zim did so well when right after the IPO, they were paying a dividend north of 100%. I'm not. That's not a
correct
misquote. 100%
for that's how much money they were making.
A year and a half. It wasn't they just paid it once. For like a year and a half, they were paying 60-70% yield, because shipping rates they just entered the market at the right time. Shipping rates went through the roof. They made a ton of money, but it's a volatile market, so a lot of people lost.
Yeah, it's it brings up the topic that I talk about is it's easier to find a stock that you really like and buying it. Like, okay, I'm going to buy it, and it's harder to figure out when am I going to sell. And Zim is one where I had already had an exit plan, but then that changed when I wanted more cash, and it ended up being the stock that I'm okay. This is the one stock I'm going to sell during that 2-week time period. So that's one of the things that you got to think about with Zim. You look at this chart and you're like, you want to be hanging out with, you don't want to hang on to this stock too long, right? It's not going to be a stock that's going to go up to $100 a share. I don't think. I could be wrong, but it's not going to be smooth and up to the right. Let's say like a Apple or a Microsoft. Those stocks just continue to go up because they have these massive businesses that have reoccurring revenue, reoccurring free cash flows. So yeah, investors are super happy with those stocks, This one's a different game. This one's, in my mind, you have to decide, how am I going to get out? If I'm getting in, okay, fine, let's ride this thing out, but I'm going to exit if these things happen. I'm going to exit at this point. If it goes up 20%, 50%, you tell yourself what it is, or I'm going to exit down on the downside. If everything that I thought is wrong and the stock starts to tank, do I sell when it went down 30%, 40%? Where am I going to sell?
Right.
So.
Yeah. Zim's a little too risky. Not because of the industry. It's Kirby is the biggest freight shipper, and that's a much more stable company. I mean, it had big swings like Zim, but it's been around trading for over 30 years. So I remember I did a video on them. It's probably not that popular. But yeah.
So let me say hello to Tomas. Very nice of you to join. He's down in Argentina, and Shadow Guys in Switzerland. So we've got 3 continents covered, because we're in North America. We got South America. We got Europe. We just need a few more continents in it. And actually,
we got
Enkiter's in Israel. So
somebody's from
everywhere.
Eurasia, New Zealand.
Oh, there we go. And that's part of Asia, I believe. I could be wrong,
it's Eurasia, isn't it? Australia's its own continent, I believe.
And the reason I say that, right, is whenever I get like the Asia report, Australia and New Zealand's always put in that report, so I could be wrong.
All right.
But I think you're right that Australia is so big, it's its own continent.
Yeah, I think it's listed as one of the continents. Some call it Eurasia, Eurasia. Are you still here, Stinkbid? Maybe you could explain that to us. Is he the one from? Oh, no, Neil Weston is the one from New Zealand.
New Zealand? He's a Kiwi, right? That's what they refer to the folks out there. I've heard New Zealand is beautiful. The geography is unique and really cool.
Yeah, I would love to go.
All right, so let's try to land the plane here. It was an awesome session, man. Thanks so much. I appreciate your time. I don't exaggerate when I say I've seen well over 400 or 500 of your videos. So thanks for putting in the labor to make those videos. I've learned a ton. Thank you for doing that.
Thanks for watching. Yeah.
Thanks for joining my live stream. It's an open invitation. If there's anything I could do for you, I'd appreciate knowing so I could do it. And it'd be great to get back together, maybe in a month or 2 months.
Yeah. Yeah, absolutely.
Maybe we could do the election day live stream, cover stocks and see how they're going. Like, oh no, that might be
taking off of work to do a live stream.
All right. Thanks, Scott. Everybody, thank you so much for tuning in, and really appreciate everybody's support.
Okay. Yeah. Thanks, everyone. Thanks, Victor. Okay. I'll talk to you later.
All right.
Okay.